If you've ever been short on cash before payday, you might have seen an ad for a payday loan. Borrow $500 today, pay it back on your next payday. It sounds simple, but here's the truth that lenders don't advertise. A typical payday loan carries an annual interest rate of nearly 400%. In the next 7 minutes, I'll show you exactly how that math works, why it's so dangerous, and how millions of Americans get trapped in a cycle of debt. Let's start with the basics. A payday loan is a short-term, small-dollar loan, typically $100 to $1,000, that's due on the borrower's next payday, usually within 2 to 4 weeks. The application process is simple. You provide proof of income, a bank account, and an ID. Credit checks are minimal or non-existent. That simplicity is by design. The lender gives you cash or a direct deposit, and on your next payday, they withdraw the principal plus fees from your bank account. Now, here's where the math gets ugly. Payday lenders don't call it interest. They call it a fee. A typical fee is $15 for every $100 borrowed. That might not sound like much, but here's the trap. That loan is only for 2 weeks. To calculate the annual percentage rate, or APR, you take that $15 fee, compare it to the $100 borrowed, and multiply it over a full year. For a 2-week loan, a $15 fee on $100 works out to an APR of almost 400%. In some states, fees can be $20 or even $30 per 100 borrowed, pushing the APR to 521% or higher.
Let me give you a real example. You borrow $300 before your next payday. The fee is $15 per $100, so you pay $45 in fees. Your total repayment is $345. That's $45 for 2 weeks of borrowing. Now, if you can't pay that back on time, and the Consumer Financial Protection Bureau found that 80% of payday loans are not repaid within that 2-week window, the lender offers you a rollover. You pay another $45 fee, but you still owe the original $300. After just 4 weeks, you've paid $90 in fees on a $300 loan. Do that for 5 months, which is the average time borrowers stay in debt, and you've paid $750 in fees to borrow just $500. Now, here's the really disturbing part. Payday loans are designed to trap borrowers. The typical payday borrower earns about $30,000 per year, is employed, and is using the loan for routine expenses like rent, utilities, and food, not luxuries. If you couldn't afford your expenses before the loan, you certainly can't afford them plus a fee on your next payday. So you renew, paying another fee but never reducing the principal. The median borrower takes out 10 loans per year, spending more than 5 months in debt. Only 14% of borrowers can actually afford to repay their loan within the initial term. Let me put this in perspective. The average credit card APR is around 21%. A personal loan might be 14% to 35%. A payday loan, 391% to 600% or more. In Texas, where there are no interest rate caps, rates can go as high as 662% on $300 borrowed. Some lenders have been sued for charging rates over 750%. That means if you borrow $20 for 7 days, you could end up paying nearly $3 in fees, which doesn't sound like much, but translates to an annual interest rate of over 750%.
Now, what can you do if you're trapped in a payday loan? First, if you live in a state where payday lending is illegal, like New York, which bans them entirely, you should never take one out. Second, if you're already in a loan, ask your lender about an extended repayment plan. Some states require lenders to offer these at no additional cost. Third, consider alternatives: credit union loans, payment plans with creditors, assistance from social services, or even borrowing from family. The Consumer Financial Protection Bureau also allows you to submit complaints if you believe a lender has violated the law. To summarize, payday lenders make 400% interest by charging fees that seem small but compound rapidly over short loan terms. They trap borrowers in a cycle of debt where most people can't escape. The average borrower takes out 10 loans per year and spends 5 months in debt. The system is designed to profit from people who can least afford it. Thank you for watching. Subscribe for more practical money guides.